Assalamu alaikum everyone. Can you guys hear me properly? Am I audible? Thank you. Thank you for the feedback. So, how's the exam preparation going? So it's like 2 weeks from now? No, not 2 weeks. To be exact, it's 1.5 weeks, approximately 10 days from now. In fact, more than 10 days. So, how's the exam preparation going? It's 7 days. Exam is on 7th and today's 24th. So 4 plus 7, approximately 10, 11 days left. Good to hear this. Going on well, going fine, going fine. So just to share with you guys, I hope you guys, like this is on track to you, that this is the last attempt of ATX where the professional marks are 4. From next attempt onwards, there will be how many professional marks? How many professional marks would be there from going forward next attempt? Yep. So give it a proper respect so that like gaining, we normally struggle in gaining the 4 marks only, the professor 4 marks only. And now across the all of the professional exams, there are 20 professional marks, which are in my personal opinion too high. But ACCA has given so many tips how to grasp them. Great. So I hope you guys had previous 2 sessions, not previous 2 sessions, one session earlier with Sarzia. Yesterday, there was a session scheduled, but he was unable to conduct the session due to some reasons. So today we are meeting, tomorrow we will be meeting. For today, what is in my mind to tackle out basically 9 marks to be specific from section A and how to attempt the text planning related questions. So this is my idea for today's session, and tomorrow I will be focusing on the section B type questions. Okay. And while we are discussing section A type questions today, I hope this thing would be in your track, like question 1, question 2. Either of these 2 questions, there will be 4 professional marks and there will be 5 marks on ethics. So I personally believe purely these 9 marks are non-text related marks. So I would be addressing first how to grasp these 9 non-text marks along with how to approach the scenario type questions relating to the text planning kind of stuff, the comparison between either we do this or do that kind of comparison. So this is what in my mind for day 1. In the meanwhile, if you guys have any kind of query, any kind of question, you guys can raise it, preferably now, preferably towards the end of the session. You can ask, but not preferably during the session. So if you guys want to ask any particular thing, you want to discuss any particular point, feel free to ask, feel free to raise your question. If any one of you want, you guys can unmute your mic, raise your question, and then again go back on. So, uh, any question at the moment as an starting point? I repeat, any question as an starting point before I start properly? If there's any question from your side, please do let me know. So you want to start? Okay, fine. That's perfect. I would have loved to hear the questions from you guys, but if you guys have no question, then I don't mind starting now. uh, Hussein, honestly, if you are asking this question to me, how many questions should be done from the exam kit now? It means there is something in your heart, like we should do complete questions, and I am due to any of the reason you are unable to do complete questions, and you want to get it blessed from me, like doing reduced practice is fine. You can do that, but somewhere in your heart, you have a strong feeling like you have to do complete exam kit. Otherwise, you wouldn't be raising this question. And that's my interpretation. So whenever anyone asks me question like that, like how many questions should be done from the exam kit or stuff like that, whether we should cover the book or not, such related questions. So I always, my mindset is like, such a student is aware somewhat, it is something which has to be done. He or she is not doing that or unable to do that and want to get it blessed from me, or you can say looking the shoulders of the tutor, like tutor we discussed with you, that contains your blessings, not to cover the whole of the stuff. So concludingly, Moses, your question is noted. So what is the best way to relieve company losses when you have current year carry forward and carry back? So now the strategy is whether you want to adjust the losses as soon as possible, or there is some other preferable thing. So for companies, the rate of tax is not the factor at all, because the current year rate of tax is like 19, prior year 19, the next year is 19 or will be 19 for you. So the rate of tax is not the factor. Since apart from in carry forward, there is no maximum possible extent. In current year carry back, there is maximum possible extent. So the waste of QCD is the first factor to consider for current year carry back versus carry forward. Second, and the most important thing is, normally whenever you carry forward the loss, it is basically you realize the loss today, but you will be gaining its benefit not today, rather you will be taking its benefit tomorrow. So the important thing is we need to consider what is the strategy of the business. Either they want the losses to be adjusted as soon as possible, or they want to adjust the loss in some other different assumption lines. So we need to look into the question, and the question will guide me what is my strategy to be exact. So normally losses are relieved on a FIFO basis. So FIFO basis means the loss which arose in the first instance should be adjusted in first instance, and the loss which arose in the second instance would be adjusted in the second instance. So that is the principle. But if I was answering your question as if which loss to be I was like whether we should go for current year or carry back or carry forward. Thank you. Any further question before we proceed? The instead that this understanding is correct. So loss. So generally the strategy is losses to be adjusted as soon as possible. But still, I would emphasize on one word. This is generally the most favorable strategy. So that's not the only strategy. Generally, this is the most favorable. Well, uh, perfect. Thank you for the questions. So like I said, what I'm going to discuss today is basically the comparison between different approaches. We will be first having some sense on the area relating to ethics, then some sense on how to write a report, how to write a letter, key contents of report, key contents of letter, and then we will be starting up a question. Okay, the first discussion is around what are the implications if, for example, I am a company and I'm going to sell out the sale, I'm going to sell out the shares of another company, or if I am a company and I'm going to sell out the trade and assets of another company. So right now the discussion is around what are the tax implications under both the options. I hope what are we going to discuss is clear, right? Now, I hope I am audible. I feel like there is some audio related issue. Okay. Sale of shares. So, what are the tax implications if we sell out the shares? In the sale of shares, there will be chargeable gain or capital loss on the disposal of shares in the company. But if the shares qualify for SSE, gains would be exempt, loss not allowable. What are the implications if we are going to sell the trade and assets of another entity? Mm, Chargeable gain, allowable capital loss arise on disposal of every single chargeable asset in the business. For example, land, building, investment, etc. But chargeable gain is not applicable on car, plant and machinery with value and cost less than 6,000 net current assets, i.e. for capital gains, there was a list of exempt assets. And if the asset is in the list of exempt asset, there is no capital gain on it. Rollover relief may be available. So uh, in capital gains, there is a concept of rollover relief. Taxable trading profit, allowable trading expense on disposal of intangible fixed asset. So I hope you guys recall the discussion around the intangible fixed asset. So intangible fixed asset categorized into two categories: limited useful life, unlimited useful life. Unlimited useful life, no debit, credit, no income expense allowed throughout the period. At the time of disposal, if gain recorded in trading income, if loss recorded along with the deducted from the total income along with QCD. So, taxable trading profit, allowable trading expense on disposal of intangible asset, for example, goodwill, license, franchise, etc., except loss on disposal of goodwill, which is a non-trading debit. However, intangible rollover relief may be available. So, on intangible assets, we still get the rollover relief. Stamp duty. Stamp duty is payable at 0.5% by purchaser of shares. So the purchaser always have to pay the stamp duty at the rate 0.5%. Stamp duty, land tax payable by purchaser of land and building. So the important and the common point is stamp duty is payable by purchaser. It is not payable by seller. It is payable by purchaser. So it would not impact your selling decision. However, it will impact your purchasing decision, but I repeat, it will not impact your selling decision. Number of related 51% group companies. If company is leaving the group, related for the whole chargeable accounting period when leaves group, but not related to companies in new group until next chargeable accounting period. So I hope you guys recall the discussion around the treatment of associates. So this point belongs, if a company joins a group this year, it will not be counted as an associate from this year. Rather, it will be counted as an associate from next year. And if a company is leaving the group this year, so that would be counted as an associate this year, would not be counted as an associate from next year. Decrease in number of related companies in old group from next chargeable accounting period. But if you sell out the trade and assets, the company does not leave the group. The important thing is like it will remain part of the capital gains group. It will remain part of the group losses group. Related for the whole of chargeable accounting period. It will remain part of your accounting period. But if company sell its only trade, it will become dormant. And if the company becomes dormant, that will decrease the number of related companies in old group from next chargeable accounting period. So in this period, it will be counted as an associate, but from next period would not be counted as an associate because we do not consider dormant companies in the count of associate. Degrouping charge. Degrouping charge arise in the company leaving the group. If it is in a capital gains group, received an asset via a no gain, no loss transfer in the 6 years prior to leaving the group, added to the sale proceeds received of disposal of shares and increase gain on those shares, but ignore if SSC applies. But from a degrouping perspective, there will be no degrouping charge, as degrouping charge only arises on the sale of shares in a company, not on the sale of trade and assets. Value of assets transferred. So for if we sell out the company, assets transferred with the company at tax written down value. So whatever is the carrying value of the assets today, that will remain constant. No balancing charge or balancing allowance arise. Capital allowances continue to be claimed by the company on tax written down value in future. Base cost of asset for chargeable gain purpose remains unchanged. Right? Just imagine if I'm selling out the shares of company A, what will be the impact on the value of assets of company A? First question, would there be any impact on the value of assets of company A? The answer is no, the value of assets remains unchanged. So this is exactly such things are addressed over here. But if we are transferring, if we are selling out the trade and assets transferred to new group company at market value, balancing charge and allowance arise in old company. So from a capital gains perspective, remember, from a capital gains perspective, if any asset is recorded in pool, it will be never ever zeroized, except of two situations. First situation, either the company cease the business or it is ceased to trade. So like I said, if a company is going to be, if a company is selling out say trade and assets, it might become dormant, and dormant means the business is seized. So in such situation, from a capital allowance perspective, the balancing allowance and balancing charge will arise, right? Capital allowances may to be claimed by new group company on market value. So new company would be claiming the capital allowance on the new value. Base cost of assets for capital gains purpose would be the market value at time of transfer. So if you are transferring the asset, whatever is the today's market value, just a question, emerging theme related question. On this point, just a question. ECA would be available if a company is acquiring the trade and assets of another company. Would ECA be available to another company? Would ECA be available to another company? I hope you guys recall the concept of ECA, enhanced capital allowance, as part of the capital allowances. So I hope you guys are there and listening to me. So just to share with you, ECA would not be available. Why ECA would not be available? Because ECA is only available on purchase of new assets, new plant and machinery. Since this asset would not be new plant and machinery, hence ECA would not be available. That's correct, Easter. Exactly. Chargeable accounting period. So with respect to chargeable accounting period, Chargeable accounting period remain unchanged for the company. But if company sell its only trade, it will cease to trade and chargeable accounting period will end. Value added tax, the VAT implication. No VAT arise on the sale of shares because sale of shares are like exempt from VAT, right? Because it is the outside, not the word exempt is itself wrong. It is outside the scope of VAT. But but for VAT, if you are selling out the trade and assets, it is basically transfer of going concern rules will probably apply. And if the transfer of going concern rules will apply, the transfer would not be a taxable supply. No VAT arise on transfer unless transfer land and building on which there is an option to tax has been opted. The losses, if company leaving the group is loss making, time apportioned trading loss for chargeable accounting period, group relief possible to old group up to the date an arrangement is in place to sell the company. No group relief from date of arrangement to sale of actual sale, because for group losses purpose, the company is no more part of group losses group the day the arrangement to sell the company has been established. Group relief possible to new group from date to change in ownership. Normal loss relief within the company itself available throughout. So the above all discussion belongs to the group losses group. The normal relief which resides with the company, that would remain available to the company. Trading losses brought forward that go with the company can be used by that company in the future, but watch out for major change in nature or conduct of trade within 5 years, starting 3 years before the change in ownership. Trading loss brought forward cannot be group relief for 5 years following change in ownership. But if we transfer the trade and assets, what will be the implications? If company whose trade and assets are sold are loss making, trading loss stay with the old company, not transferred to the new group company. Trading losses have limited use. And trading losses have limited use. And what are the limited use? Possible claims, current period claim against total profits before QCD, group relief to old group, and if still a loss, useless as company cannot carry forward the loss if company cease to trade, because you have transferred all of the assets, because you have transferred all of the trade and assets. So if sell its only trade and cease to trade, terminal loss carry back for 3 years against total profits before QCD relief. So the terminal loss relief would then be available. Summing up, what are the advantages and what are the disadvantages? So advantages are no tax on disposal if SSE applies. So we need to be careful about the SSE. No balancing allowance or balancing charge arise. Loss relief goes with the company to the new group. Disadvantage, all of the company is transferred, all of the assets are transferred and all of the liabilities are transferred. So all of the assets and liabilities are transferred. From a one perspective, it is bad thing. So you are losing the opportunity to retain the assets of your own wish. So it is quite possible you want to retain some of the assets with you, and you are losing that opportunity. Sale of trade and assets can transfer just the assets the purchaser wants. So not necessary the purchaser wants to purchase all of the assets, because if you are selling out the shares, you are selling out the whole of the company, and all the wanted assets and unwanted assets will be transferred. Disadvantage, the gains would be taxable. The gains may be deferred, but not exempt, so it would remain taxable. Balancing allowance and balancing charge would arise. Losses do not go to the new group, so loss would reside within the company. Any question around this? That was the first comparison. Let's look into another comparison. Balancing charge and balancing allowance. So to Moses, it's basically when, okay, so balancing allowance, balancing charge, that is the context of capital allowances. With respect to capital allowances, at the moment, I'm not talking about company, I'm talking about capital allowance. So from a capital allowance perspective, there can be maximum 4 columns where the assets, where the plant and machinery would be categorized. One is the main pool. Second one is the special rate pool. Third one is short life asset. And fourth one is privately used asset. The privately used asset and short life asset are always single assets. So whenever they are sold, there will be balancing adjustment which needs to be performed, like either to calculate the balancing allowance, balancing charge, and the asset column would be like zeroized. Asset column would be like zeroized. But for the pools like main pool and the special rate pool, the problem with the pool is pools once created, it balance never ever gets zeroized. It remain goes on and on and on and on unless your pool reaches to a small pool balance, which is less than 1,000 for a 12-month period, or you are disposing of the asset at time of business cessation. So if you are selling out the assets at time of business cessation, you will get the balancing adjustment, balancing allowance, balancing charge, whatever, with respect to capital allowances. So this is the brief overview of the balancing adjustments with respect to the capital allowances. So anything which is not clear now, do let me know. Welcome. Any further question, any further thing which is not clear while having the discussion of sale of shares versus sale of trade and assets? If not, so I'll move forward then. Okay, the next discussion is around impact of different level of investment. So what will be the tax implications if we have less than 50% shareholding, if we have 50 to 75% shareholding, and if we have greater than equal to 75% of shareholding. Associated less than 50, the answer is no. More than 50, yes. More than 75, still yes. Can join VAT group, less than 50, no. Less than 750, yes. Less than 75, yes. It means the capital, sorry, it means the VAT group can be established if the shareholding is like more than 50%. Group relief group. Less than 50, no. 50 to 75, no. More than 75, the answer is yes. Consortium relief. Consortium relief. Less than 50, possible. I'm not saying for sure yes, I'm saying possible. 50 to 75, possible. More than 75, the answer is what does this asterisk means? It depends on ownership of remaining shares. For a consortium, at least 75% of shares in consortium company must be owned by companies, each of whom has at least a 5% stake. Capital gains group. Less than 50, does the capital gains group be created? No. More than 50 but less than 75? No. More than 75, the answer is yes. At times, normally ATX students ask me whenever we have such discussion, they normally ask me a question like, sir, we studied at time of capital gains group, direct shareholding should be more than 50 and direct should be more than 75. So why you are not capturing that indirect shareholding element over here? Is this thing clear? Like the point which I'm trying to raise. Answer to this piece is basically the direct shareholding is only counted. Sorry, indirect of 50% is only counted when the direct of 75% is met. If direct of 75 not met, indirect more than 75 is met, it is not effectively would be part of capital gains. So same thing goes over here. We are not talking about indirect level of investments over here. Rather, we are talking about the direct investments over here. Okay. Other issues, losses brought forward can be used. The answer is yes, because there is no change in ownership. More than 50, more than 75, possible loss of brought forward losses. When there will be possible loss? If there is major change in nature or conduct of trade, or revival of negligible activities. Stamp duty, whatever is your shareholding, you have to pay 0.5% on share purchase amount. Now, different tax implications if you are joining a 75% group and if you are leaving a 75% group. Associated company. The associated company would remain associate for whole of chargeable accounting period in which a purchase takes place. Associate for a whole of chargeable accounting period in which sale take place. To add the word not to be. Associate. Group relief only possible from date of joining the group. No relief for pre-acquisition losses. Cease from date arrangements come into force for company to leave the group. Capital losses. Pre-acquisition capital losses cannot be used to relieve gains in other group companies. No relief against group gains for capital loss realized after leaving the group. The grouping charge is not applicable if company is joining. However, if a company is leaving a group, the grouping charge arises if company leaves gains group is still own an asset which received from another gains member group at a no gain, no loss transfer within last 6 years. The grouping gain added to the parent company share proceeds. SSE may be available. Now, the implications of VAT. No VAT on share sale or purchase. Can join a VAT group, but that is optional, not a mandatory thing. No VAT on sale shares or purchases. Will leave VAT group unless parent company still owns more than 50%. Because if less than 50%, company cannot be part of capital gains group. Stamp duty. Purchaser pay 0.5% on share purchase. No stamp duty for vendor. Stamp taxes. Group transfer. Transfer of property between gains group members are exempt from stamp taxes. Stamp taxes may be payable if leave group owning an asset transferred in by another group member with stamp duty, land tax exemption within last 3 years. So what is within last 3 years? So like we have a concept of degrouping charge for capital gains, in the same way we have the concept of degrouping charge for stamp taxes, where the tenure is 3 years, not 6 years. I discussed two different level of investments with you guys. If there is any question around this, please do let me know. No question. The next discussion is around overseas branch versus overseas subsidiary. So the next discussion is basically what are the implications? What are the implications if we are having an overseas branch or if we are having an overseas subsidiary? Scope and basis of charge. Overseas branch is extension of UK operation. All profits arising assessed on the UK company because it is part of your branch. If a branch is controlled from UK, then it is trading, then it's trading profit added to the UK trading profit. If trade is the same as in the UK, including trading income and available for relief of brought forward trading losses. However, DTR is available on overseas branch, can elect for profits to be exempt. Overseas subsidiary. Overseas profits not assessed in UK if left in overseas subsidiary. Profits remitted to UK parent company may be chargeable when received. Dividends are not assessable. Interest income from loan to overseas subsidiary is assessable as interest income to the parent entity. Trading loss relief. What are the trading loss relief available? Can relieve trading losses of overseas permanent establishment against UK profits unless the loss can be relieved in the country in which it arose. UK losses can be relieved against overseas permanent establishment profits. No relief for election if election for branch exemption is made. UK trading loss cannot be surrendered to overseas subsidiary. Overseas loss from 75% subsidiary in European Economic Area can be surrendered to UK parent if no alternate relief in overseas. Capital allowances available on overseas located assets purchased and used by overseas branch unless election for branch exemption made, not available under UK tax laws. Chargeable gains. Capital gains computed using UK rules. Rollover relief is available on an reinvestment. Capital allowances can be utilized. No capital gains or utilization of capital losses if branch exemption election is made. Not assessed in UK. Impact on tax rates. None, as not a separate entity. Impact on tax rates as an associate, the upper and lower limits for as an associate, the profit threshold limit is reduced. Easter EEA is European Economic Area. So till the Brexit, it exists. Post Brexit, it does not exist. So this 75% element, this clause is only applicable if laws belongs till the time Brexit actually happens. So since this is in the discussion, a very small discussion, part of the syllabus, that's why I kept it here. Otherwise, I really doubt that this piece will be examined. Any further question, please? If no, so mainly my discussion till now was around the company related comparisons between A and B. Now I'm going to have discussion around the salary versus dividend. You are welcome. Salary versus dividend, where my discussion is around, for example, if I am a shareholder and or I am a director of a company, I am shareholder and or director of a company. I can see there are some surplus funds in the company and I want to withdraw them. There are some surplus funds in the company and I want to withdraw them. I can withdraw the surplus funds either in the capacity of, I can withdraw them as a director remuneration, as a salary, you can say in simple words, or I can withdraw them in the form of dividend since I am the shareholder also. I can withdraw them as dividend. So whatever way I choose, there will be different tax implications, right? So what are the tax implications if I withdraw them as a salary or if I withdraw them as a dividend? Rate of income tax, it would be 20, 40, 45. I have to pay tax on that income. And if dividend, I have to pay tax at 7.5, 32.5 or 38.1 post NIC is paid by individuals. Individual must pay class 1 NIC on the salary at 12% or 2%. So depends upon his salary. No NIC is payable on dividends, right? Because NIC is on employment income or trading income. It is not on other incomes. NIC paid by company. Employer must pay class 1 NIC on the salary at 13.8%. Note that 4,000 NIC employment allowance is not available where the director is no NIC is payable on dividend. So there is no NIC on dividend income. Corporation tax implication. The salary paid to employee and the NIC is paid by the company are treated as a staff cost. This reduces the trading profit of the company and the corporation tax payable accordingly. Since dividends are paid from the after-tax profits, hence they have no corporation tax implications. Pension income. Salary is earned income and is relevant earnings for pension tax relief purposes. Dividends are not earned income and are not relevant earnings for pension tax relief purposes. The company must have distributable profits to be able to pay a dividend. Distributable profits like the revenue reserves must be there. Formalities, if bonus is accrued at the end of accounting period, it must be paid within 9 months of the end of the accounting period and must comply with IAS 37 requirements. To Esther, the answer is no. So that is not basically referral over here. On this point, what my theme is, the maximum amount which you can contribute into the pension is higher of 3,600 or relevant earnings, right? If you contribute beyond this higher of amount, it's not, that would not be counted for tax purposes into the pension, right? Higher of 3,600 or relevant earnings. Now, what is relevant earnings? Relevant earnings is the sum of employment, trading, and FHL property. So if you are withdrawing the funds as a salary, it will increase your maximum pension contribution limit. But if you withdraw as dividend, there will be no impact on your maximum limit to contribute into the pension. Welcome. Any further question around this, please? Now, operating as an unincorporated business versus a company. So what are the different tax implications if you incorporate, if you are operating your business as incorporated entity versus a unincorporated entity? Status would be of sole trader or partnership. For corporate body, likely to be a closed company. Why likely to be a closed company? Because closed company, any company which is controlled by 5 or less shareholders or all shareholders are directors. So such company would most probably be a closed company. Taxation of profits. For sole trader, the current year basis rules would apply. adjustments for private use has to be made. Personal allowance would be available. You have to pay income tax on profits at the rate 20, 40, 45. Class 2 and 4 NIC would be applicable. Whereas if you operate as a company, accounting period, the tax would be as per accounting period basis. No private use adjustment. For companies, there is no concept of personal allowance. Companies has to pay corporation tax at 19%. Extracted profits would be subject to income tax and NIC if extracted as a salary. Relief for losses. So if there is a loss, what will be its implications? Available against total income of individuals, against total income of current year and of previous tax year with an extension against capital gains, carry forward against future trading profits of same trade, loss in first 4 tax years set against total income of 3 preceding tax years on FIFO basis. Available against company's own profits only, against total profits of current year, then carry forward against future total profits. No additional operating year loss relief for companies. So for companies, we do not get the concept of opening year loss relief. Withdrawal of funds. So if you are working as a sole trader, you withdraw the funds. There are no tax implications. Why there is no tax implications? Because all of the profits are already assessed as your trading income. The discussion around salary bonus versus dividend, like we have on the previous page. For VAT, individual registers. For VAT, the company would register. Capital gains tax based on individual chargeable asset. BADR relief. And since it is a business, so it should qualify for gift relief, rollover relief type of thing. Capital gains tax, gain on shares sold. BADR or investor relief would be available. So I need to carefully look for the conditions. Shares in an unquoted trading company qualify for gift relief if gifted. From the IHT perspective, there would be 100% BPR, there would be 100% or 50% BPR. Why 50%? So we need to check the categorization, right? Then we can decide. Payment on account of income tax by 31st January during the tax year, 31st July following the end of tax year, balancing payment 31st January following the tax year. For companies, pay on employment income on monthly basis, corporation tax is payable at 9 months and 1 day after the end of each accounting period. So again, taking a pause, looking for your feedback, for your questions, if any. Any question, please? If no, then I like to have a 10-15. So there are some other things as well before these comparisons. So not considering the time, I'm not going towards there. Rather, I am going to start my discussion around the ethics. Probably I would not go in each and every line item of ethics. Rather, I would be discussing from a broad perspective how and what should be covered in the ethics from the examination perspective. Okay, so the broad themes which are examined in the ethics universe is basically uh, what will be the ethical implications if you are receiving the new what if you are receiving the new client, so what will be the implications on that front? What are the possible potential conflict of interest which can be seen, for example, if you are acting as a tax advisor to a company and to its, for example, shareholder or to its directors or to its, for example, CEO, to its president. So what are the possible tax implications of that? HMRC errors. So being tax advisor, if you observe any kind of error made by HMRC in the tax return, for example, if there is an excess repayment, so what about that? Uh, the implications of tax avoidance versus evasion. So what are the implications uh, uh, if the client is involved in tax avoidance, if the client is involved in tax evasion? And what is a brief overview of what is money laundering regulation and what are the do's and don'ts of money laundering regulation and what are the key responsibilities of the money laundering reporting officer, abbreviated as MLR. So these are the broad 5 aspects of the ethics related discussions which we will be discussing over here in detail. Generally, I'm not saying always, generally, the discussions are on the same lines with respect to the ethics. The discussions are on the same lines. So not very much diverse discussions we observe in the exam kit or in the past exams. Okay. So if there is a situation of a prospective client, so with respect to prospective client, what are we supposed to consider? What factors need to be considered? Further aspects, uh, whether there is any threat to compliance with these principles, is there any threat to integrity, is there any threat to professional competence, uh, why they are shifting to us, what we should contact with the previous tax advisor, stuff like that. Conflict of interest, what could be the possible conflict of interest? What could be the possible conflict of interest? And how it would be acceptable to act for both parties. So how to avoid the conflict of interest, and if you are unable to avoid conflict of interest, then what would be the solution? If you observe any type of error on HMRC end, then you need to discuss it with the client. Being tax advisor, you need to ensure that client inform the HMRC. Irregularity could be not declaring the income, claiming release which are not entitled, not notifying HMRC they have made a mistake rising to an underpayment of tax or an increased repayment. Okay. If a client made an error, it's necessary to decide whether it is a genuine error or deliberate or fraudulent. Once an error has been discovered, the member should explain to the client the requirement to notify HMRC ASAP and the implications of their not to do so. If client refuse to make a full disclosure, the member should cease to act for the client, must also write to HMRC informing that they have ceased to act for the client, but without disclosing the reason, must that consider their position under the money laundering regulation. A small discussion about tax avoidance and tax evasion. Tax evasion is unlawful. Tax avoidance is the use of legitimate means to reduce the incidence of tax. Money laundering. All business within the regulated sectors must appoint a money laundering reporting officer within the firm. Where a report is made, the client should not be informed, as this may amount to tipping off, which is an offense. The concept of GAR. What is the concept of GAR? GAR is basically Journal Anti-Abusive Rule, which is made by HMRC, where the ideology is to combat tax advantage arising from abusive tax arrangement. What is abusive tax arrangements? Arrangements are abusive where they cannot be regarded as a reasonable course of action. For example, where they include artificial steps or intend to take advantage of deficiencies in the tax legislation. If the general anti-abusive rules applies, then HMRC may respond by increasing the taxpayer liability, accelerate tax payment, or delay refund and ignore artificial steps in an abusive scheme. The best example of GAR which we study in the ATX is the concept of IR35, the concept of personal service company. That is one of the best example of GAR. Like where they disregard the artificial steps, where they disregard the formation of an artificial company and do tax as basically it is your employment income. A penalty of 60% of tax advantage obtained through GAR can be charged. It's not must be charged or will be charged, can be charged. Dishonest conduct. There is a civil penalty of up to 50,000 for dishonest conduct of agents. In case where the penalty exceeds 5,000, HMRC may publish details of penalized tax agents. With agreement of tax tribunal, HMRC can access the working papers of dishonest agent. So that's not a by default option. That is, this option is only available if the tax tribunal allows. So with this, we are done with the ethics related discussion. Anything which is not clear, please do raise it, else I'm good to start the question. Anything, please? In case of no, I'm good to close this file. Uh, the reason being I'm smiling on this point is Easter, because it is something which would take normally, if I walk it through brief overview, it would require at least 15 to 20 minutes. So let me think on this line. I keep your request reserve in my mind. Let me think of this. How can I accommodate you, or how can I complete your this request? So give me some time to think on this. Uh, I'm heading towards a question. I'm heading towards a question, and I have already opened up my CP platform. I hope you guys can see that, right? You guys can see the practice platform, right? So you guys can see the CB practice platform screen uh, on your screens. Sure, thank you. So uh, if you can, if you see how many papers are there to practice, so there are 1, 2, 3, 4. Mhm. 1, 2, 3, 4. So there are four past papers, 3 practice exam papers. So 3 plus 2 makes it 5. Sorry, 4 plus 3 makes it 7. And 1 mock paper, specimen paper. So there are like 7, 8 papers with you. I don't want, like, I do want the practice at your end as much as you can. And I like to start from the FIFO approach. FIFO approach as in, let's start with the June 21 paper. Because I want you guys to attempt the latest paper rather than I attempt the latest paper. You guys attempt the latest paper. So how are we proceeding with the question? You guys are solving with me, or you guys are opening with me, or it's just like I'm doing the question, you guys are looking into it. If any one of you want to attempt the question with me, the paper with me, he or she can open up the paper. I don't mind waiting for like a minute. So, I guess let's start. And probably it sounds to me like I would be doing it only. So, uh, Let's start with the section A type question. So let's start with the first question. So let's start with this, please. You should assume that today's date is 1st June 2021. Your manager has received two schedules from Joe, the finance director of VNL Limited. So the name of the organization is VNL and the name of the person is Joe. The two schedules and extract from an email from your manager detailing out the work she requires you to do are included in the exhibit. The following exhibits available on the left-hand side of the screen provide relevant information to the question. Schedule 1, liquidation of VNL Limited, dated 1st June 21. Schedule 2, newly incorporated business, dated 1st June 21. Third, email extract from your manager, dated 1st June 21. The information should be used to answer the question requirements within your chosen response options. Schedule 1. As we have discussed, the company shareholders have decided to liquidate the company. A liquidator will be appointed on 1st August 21. I set out below the information you asked in relation to the sale of company's intangible fixed asset. Together with a request for further advice in relation to the payments to be made by the company to its shareholders. Sale of intangible fixed assets. On 1st September 18, VNL Limited purchased the trade and assets of a business from unrelated company. The assets included goodwill and a brand name as detailed below. The assets will be sold on 31st July 21. 31st July 21 means before the appointment of liquidator. Sale proceeds 75, cost 15, amortization since acquisition 19,000, brand name 5750. Further advice, payment to the stakeholders. An interim payment will be made to the shareholders followed by a final payment at the conclusion of the liquidation, which will take place in Feb 22. It is 1st August 21 today. I have been asked to consider the possibility of making the interim payment prior to the appointment of liquidator. Okay. Exhibit 2. What was the Exhibit 2 about? Exhibit 2 was about the incorporated business, new unincorporated business. I can now confirm that I will commence trading as an unincorporated trader, means sole trader, on 1st November 21. Tax adjusted trading profits. When we last met, you calculated that an accounting date of 31st March and making my first accounts to 31st March 22. My taxable profits based on the monthly budgeted TATP of the business would be 21-22, 22-23. I set out below a remainder of the monthly profits figure on which you base your calculations. 1st November to 31st December, number of months to TATP per month. 1st January to 31st March, 1st April to 31st August, from 1st September, 8,500. I have now realized that making my accounts up to 31st July and continuing with an accounting date of 31st July would also be suitable commercially. And I would like some guidance from you as to which date I should choose. So the choice of accounting date with respect to the basis period calculations. Interesting. Cost already incurred. Since 1st October 20, I have been purchasing consultancy services every month in respect of the design and manufacture of the product the new business will be selling. On 1st May 21, I purchased computer equipment for use in the business. I have identified the building for use as my business premises. It is a commercial property unit which was constructed in 2004. I have agreed a price with the vendor of 190 plus VAT. I intend to lease a third of the building to an unrelated business until my trading activities have gone sufficiently to acquire the use of the whole building. Uh, Please prepare notes for meeting with Joe with the following. Liquidation of VNL Limited. Additional information. VNL is a trading company. It has always made significant trading profits and will be profitable in its final accounting period. It prepares accounts to 31st March each year. Fine. The amortization of the goodwill was not a tax deductible expense for VNL Limited. No election was made to write off the cost of the brand name at the 4% rate. The company shareholders are all individuals. Some of them are employed by VNL Limited and include both basic rate and high rate taxpayers. The shares in VNL Limited are subscribed prior to 17th March 16 such that investor relief will not be available in respect of any disposal. Sale of intangible fixed asset. Calculate the post-tax proceeds for VNL Limited as a result of the sale of intangible fixed asset. Timing of payment to shareholder. Explain the tax rates which the shareholders will pay on the amounts received from VNL Limited depending on when the payment is made. Fine. Unincorporated business. Additional information. The taxable trading profit figure for the first 2 years in respect of 31st March accounting date are correct. So there is no need for you to check them. There will be no further significant capital expenditure on building or plant and machinery. The trading activity will be standard rated for VAT purposes. Accounting date. In order to assist Joe in choosing between the two alternative accounting dates of 31st March and 31st July, calculate Joe taxable trading profit for his 2 tax years of trading if he were to adopt an accounting date of 31st July. You should base your calculations for the 31st July accounting date on a monthly tax adjusted trading profit figures in Schedule 2 from Joe and should ignore the expenditure incurred prior to 1st November 21. Without preparing any further calculations, comment on the possible effect of Joe income tax liability for the first 2 tax years of trading of adopting a 31st July accounting year rather than the one of 31st March. State two advantages other than in relation to Joe income tax liabilities of Joe adopting accounting date of 31st March, accounting date of 31st July rather 31st March. So why it should be 31st March as compared to, why it should be 31st July as compared to 31st March. Cost already incurred in the business. In respect of cost already incurred in the business and the planned purchase of business premises, explain whether or not Joe will be able to obtain a tax deduction when calculating the taxable trading profit. Joe will be able to recover the related input tax for VAT purposes. So, interesting question, a vast question covering so many areas of the syllabus. One is the liquidation, payment to shareholders, intangible fixed asset, treatment of intangible fixed asset. Then part two is a typical individual related question where we are talking about what will be the accounting year end date, which year end date to select, and what to do with the cost which is already incurred in the business. So just to share the marks allocation for part A, one, sale of intangible fixed asset, timing of payment, accounting date, cost already incurred, and business premises. And business premises include the VAT aspect also, right? So if I ask you, majority of the requirement, is it a theoretical or is it a calculative? So I'm looking for the requirement. It is calculate, 4 marks. Explained, 7 marks. And calculate taxable profits without preparing any further calculations. State two advantages. So requirement B1 was of 8 marks. And out of 8 marks, only 1 point is of calculate. The 2 points are without making calculation. State advantages. So I hope you understand its meaning, right? In respect of cost already incurred and the planned purchase of business, explain whether or not. Again, the point here is explain. My question which I wanted to raise was, do you guys feel majority area of the question to be calculation based, or do you guys feel the majority area of the question to be theoretical based, like explanation based. What's your sense on this? Do let me know your sense on this so that I can start the question. Do you guys feel more of calculation, less of theory, explanations, writing? Or do you guys feel more of explanation, less of explanation, more in explanation? What do you feel like? I hear you, Moses. I'm not giving my feedback at the moment. I want to hear from all of you first. Can I have the feedback from others also? Easter, Shabir Sheikh. Any feedback? No one further is here? Would I assume it to be the case? I guess on a no choice basis, I have to assume this. Fine. So I waited for like silently also that someone could like wake up and ask the question, but well, fine. So it is basically, so if you ask my view, I can sense like out of 35 marks, somewhat 20 to 25 marks are based on theory, explanation, etc., etc. Only up to 10 marks, maybe. I am more conservative. Max 10 marks is on calculation. Rest all of the marks are on explanation. So since most of the part is based on explanation, I would prefer, I would advise, suggest, recommend. Keep your main answer on the word. Keep your main answer on the word and take the help of a spreadsheet where you need the calculations. Okay. I like to read the requirement again. So what is the first requirement? Prepare the notes for the meeting as requested in the email from your manager. So first you are supposed to make notes for the meeting. Notes for the meeting from your manager. The following marks are available and how the marks are available. A liquidation of VNL Limited, the sale of intangible fixed asset, 4 marks. Timing of payment to shareholders, 7 marks. Unincorporated business, accounting date 8 marks, cost already incurred, and the business premises 12 marks. Professional marks will be awarded for the approach taken to problem solving, the clarity of explanation and calculations, the effectiveness with which the information is communicated, and the overall presentation and style of the meeting notes. So fine. So here professional marks are here where I'm supposed to make notes for the meeting. How to start such thing? Notes for the meeting. For manager. The client files. Liquidation of VNL. Liquidation of VNL and unincorporated business. Liquidation of VNL Limited and creation of new. Did Joe share the name of the business? Business name is not mentioned, right? Prepared by. So your manager. So as per the hierarchy, any designation below manager would work. You can keep yourself as officer, assistant manager, associate, whatever you want to name yourself. So I like to be tax associate. Date. All of these headers would be in bold. Liquidation of VNL Limited. B1 was sale of intangible fixed asset. Intangible if I recall, with respect to sale of intangible fixed asset, there was a major calculation, right? I need to look for the requirement again. Calculate the post-tax proceeds for VNL as a result of sale of intangible fixed assets. Refer to working one of the spreadsheet. Working one. Now, if I look into the sale of VNL Limited, sale proceeds on 31st July 2021. So the sale proceeds is 75,000 here. Cost written down value. Here the net book value would be 36,000 minus 5760. Hmm. Gain slash corporation tax. Calculate the post-tax proceeds. So the requirement is to calculate the post-tax proceeds. Corporation tax on the gain this is the tax amount, right? So I'm putting it net of tax proceeds. I'm looking to your comments now. So so to Easter, schedule one is blocking the view. Yes, I understand. And I was doing it intentionally because I want to guide you guys how to manage the screen, how to work on a limited screen view. Second, why? So you can look into the spreadsheet. Why 95,000 as WDV for goodwill? Because for goodwill, by the way, in accounting terms, goodwill is never ever amortized, right? For goodwill, we do impairment testing. Goodwill is not subject to amortization because goodwill has no defined limited useful life. So goodwill is never ever amortized. But over here, they are amortizing it. So whatever will be the case, from a tax perspective, goodwill is a non-amortizable item. That's the point. So tax authorities do not allow the amortization of goodwill. So that's why for goodwill, cost or written down value would be same, but for brand name, which is generally amortized, Moses, I hope that would be clear. Any question from your side, Shabbir Sheikh? You are silent throughout. 122,616. So is it done? If yes, then I love to move to the net of tax proceeds is 122,616. Then after the sale of intangible, The second is timing of payment to shareholders. Timing of payment to shareholders. So I'm like at the start of this discussion. Yes, timing to the of payment to shareholders. So you can pay shareholder in two instances. You can pay either prior to the appointment of liquidator, or you can after. Yes, if it is prior to the appointment of liquidator. Any payment made to the prior to the liquidator will be subject to income tax, as dividend income under normal way. It means that first 2000 of from first 2000 of dividend income qualify for would qualify for dividend exemption, and the amount exceeding beyond 2000 and falling in basic rate would tax at 7.5, exceeding beyond 2000 and the amount exceeding beyond 2000 would tax at 7.5% for basic rate taxpayer, 32.5% for 38.1% for the dividend exemption of 2000 covers the dividend from all sources if someone has more than one source of dividend. Anything which is not clear in the prior to the appointment of liquidator? I hope like no question? No. Considering the time, keeping it short. After the appointment of liquidator, so after the appointment of liquidator, once the liquidator is appointed, amounts paid to the shareholders will be referred as capital gains. The amount of gain not covered the amount of gain not covered by the shareholders annual exempt amount of 12,300 would be subject to CGT either at 10% if gains fall in basic rate or 20% VNL Limited is a trading company. The following reliefs would be available BADR. If shareholder has owned the shares for more than 24 months and holds more than 5% of shares and selling within 3 years of cessation. BADR would be available if the lifetime limit of $1 million is available. The following relief the BADR would be available if the conditions are satisfied. Now, what are the conditions which needs to be satisfied? Anything which is not clear with respect to the taxation of with this discussion? Yes, please. Any question around this? In case no, which I apparently presume I have closed the appendix 1, schedule 1, unincorporated business discussion, 8 marks. You. Easter, initially, honestly, that the space was in my mind, but I not talked about it. Reason being, the company is going to cease, and you are talking about gifting the shares. Practically, you can do that. So I would not say not possible, but sorry, theoretically you can do that, but practically, would you really do that? Like if a company is about to liquidate, would you go to give the shares to someone else? So again, like I said, theoretically, you are right. Practically, it doesn't make sense. So again, like I very clearly said, theoretically, you are right. So initially, that was in my mind, but while writing for BADR, just this point clicked, and that's why I reworded my earlier line. But like I reworded my earlier line. So initially, what is in my mind? So we are transferring the shares, and so two reliefs would be available. Since investor relief was explicitly excluded, so not discussed about investor relief. But with respect to shares, the available reliefs are BADR and the gift holdover relief. So that's why I initially started about the while having the reliefs, I started in this way. But while completing BADR, I realized like we are talking about cessation. So gift relief doesn't make sense. So we are thinking in the same way. Welcome. Okay, accounting date. So we are done with these two. So accounting date, in order to assist Joe in choosing between the two alternative accounting dates of March 31st and 31st July, calculate the Joe taxable trading profits for two alternative accounting dates. Sorry. Taxable trading profit for the first 2 tax years. So it's calculates. So effect on income tax liabilities. Effect on जो income tax liabilities. And the third one is advantages of adopting 31st July accounting date. So I have like initially articulated the key bullets. Please notice one thing. I am trying my best to keep my formatting same. Formatting same as in, for example, uh, notes, then part A liquidation of VNL Limited. So A, then main heading bold. So what I'm not saying it should be same for all, but it should be consistent. So main heading is bold italic underline. So for A, it is bold italic underline. B, it is bold italic underline. If there would be C, it should be bold italic underline. Then first subheading, requirement one. So I keep it as simple underline. You can keep simple bold, you can keep simple italic, that's up to you. Then the subheading. If you look, simple italic. So I'm not saying it should be italic. I'm saying it should be consistent. That's the important thing. Okay. Working two. Now, tax year 24,500. Now, a common mistake with respect to the basis period thing. On which amount are we supposed to apply basis period thing? Keep remember, the basis period is applied on the accounting period's profits. It's not so. First, I need to make accounting period. Accounting period is like business started on 1st November and from 1st November to 31st July. First November 21 to 31st July 2022. Be with me. The profit should be for this period, the profit should be 4,000 multiplied by 2, like November, December. Then for Jan, Feb, March, it's 5,500 multiplied by 3. Then after March, April, May, June, July, 4 months. So plus 7,500 multiplied by 4. So this would be like 2 plus 3, 5 plus 4, 9. So from 1st November to 31st July, 9 months. So for 9 months, it would be 54,500. Then from 1st August 22 to 31st July 2023. It would be 7,500 multiplied by 1 plus 8,500 multiplied by 11. So that's like 101,000. I hope you guys are following my cells. Then the basis period. From business start date, from 1st November 21, nearest fiscal year end date, which is 5th April 2022. That would be referred as your fiscal year 21/22. 54,500, this profit was for a period of 8 months. No, sorry, 9 months divided by 9 multiplied by from 1st November to 5th April. We are counting 5 months over here. So for 5 months, it's 30277. For 22-23, the second step, we cannot go 12 months back. So as a result, we have to go 12 months forward from the business start date. The profit for this period would be 54,500. So captured 9 months. As a result, there will be some overlapping, I agree, but at the moment, my focus is not to calculate the overlap, right? So for me, the fiscal year 21-22, if I put the year end date of 31st July, I'm done with the calculations, looking for your feedback, if any. If there is your feedback, please do let me know. Perfect. So you have calculated it, right? Now you have to provide your analysis. Now, I am going to comment on this piece. Effect on Joe income tax liabilities. Joe taxable trading profit for the first 2 tax years would be lower if he were to adopt the 31st July accounting date. Year-end date of 31st July results in higher income in 2021-22, but a lower amount in 22-23. Then advantages of adopting a 31st July accounting year end date. So two advantages. First advantage, after the first tax year, there will be greater time period between earning profits and paying the tax due on them. I do remember there were two advantages. Second advantage, there will be greater time period between the accounting year end date and the fiscal year end date. This time period can be used to plan Is this thing clear, or anything which is like not clear? Is there any question around this? Thanks, Sista, for the feedback. So considering no further query, I'm heading toward the part 2 of the question. Cost already incurred and the business premises. So for cost already incurred and business premises, what I'm supposed to consider over here? In respect of the cost already incurred and the planned purchase of the business premises, explain whether or not. Explain. Joe will be able to obtain a tax deduction when calculating his trading profit. Joe will be able to recover the related input tax for VAT purposes. So one thing basically talks about the pre-trading expenditure type of stuff, and one aspect talks about the pre-registration input VAT kind of stuff. Right? So again, need to assess on these two lines. The tax deduction when calculating taxable trading profits. Tax deduction when calculating taxable trading profit? Recovery of input tax for VAT purposes. So now there were three things. One was consultancy services. Second was computer equipment. Third is yes, consultancy services. It would be treated as an allowable expense. It would be treated as an allowable expense incurred on 1st November 2021, i.e. first day of business. It is because it has been incurred within 7 years prior to the commencement of computer equipment. Capital allowances. Capital allowances in the form of 100% annual investment allowance will be available in respect of cost of computer equipment. and it would also be treated as acquisition of acquired on first day of business. Premises. I have identified for a building to use as my business premises. It's a commercial property unit which was constructed in 2004. I've agreed to a price with the vendor of 190,000 plus VAT. I intend to lease a third of the building to unrelated business until my trading activities have grown sufficiently to require the whole building. For premises, the part of cost of premises which relates to integral features or plant and machinery would qualify for capital allowances. The balance of the cost of premises not qualify for SBA would not qualify for any allowance or SBA as the building was constructed prior to as in the building was constructed in 2004. Recovery of input tax. For no, input tax. Consultancy service is a service. Principal statement for regarding services, input VAT can be recovered if it is less than 6 months old. So let me first share the principle. Consultancy service. In respect of services within 6 months prior to the date of registration. He was starting business on 1st November 21. In order to recover, you should consider his business to be registered from VAT as earliest as possible. So general rules for commencement of, okay, so for commencement of trading business, it was 7 years. And at the moment, I am talking about with respect to trading income, not with respect to VAT. So with respect to trading income, for trading manufacturing business, it was up to 7 years. And for service business, it's up to 3 years. With respect to VAT input recovery, if purchase of services up to 6 months, and if purchase of goods, that was up to 4 years prior to the date of registration and should exist at time of registration. So since the business was started on 1st November 21, so all of the things purchased were like within 7 years. So none of the thing is like within more than 7 years, right? So for services, it's like only 6 months. So I noticed this. He started purchasing services from 1st October 20. So from that perspective, my advice is register as soon as possible, because else it will start lapsing. You cannot be able to recover. Joe would be able to recover the input tax in respect of computer equipment till 30th April 2025, provided the computer equipment remains in the business. If Joe dispose of the computer equipment prior to registration, he would not be able to recover its input tax. Yes, premises, the last piece. the amount of input tax which Joe can recover will depend on whether the whether whether he avails the option to tax or not for VAT purposes. If he opts to tax the building, he will be able to recover otherwise he will be able to recover 2/3 of it. The building would not be under capital goods scheme as the value of building is less than 250,000 inclusive of VAT. So I'm done. Uh, Anything which is not clear you like to ask, please do let me know. Again, do let me know. Easter, let me download it first. So let me save it, not download. Let me save it. Mhm. Any other things? Anything other than sharing it on WhatsApp? So let me think about IR 35. I request you to drop this piece on the WhatsApp also, so that it will remain in my mind. So a request from my side also. Drop this thing on the WhatsApp. So sir, kindly share the IR 35. Perfect. Perfect. So thank you very much from my side today. See you guys tomorrow. And like we discussed in detail, we were not in rush. We discussed in very much detail how to write the answer of section A, especially question 1. Tomorrow we will be looking for how to write the answers relating to section B type questions. Okay. So see you guys tomorrow. Uh, good night from my side. I don't know where you guys are located. So good night from Pakistan. Thank you. Thank you.